Okay, welcome everyone. I see a lot of people here in this online Zoom. We are going to be recording this to be used for future reference, but nice to see all you people out there. I'll see a little wave of hands. All right, so this is Mortgage 101, a general overview of the home financing process. I am your presenter. My name is Joe Metzler. I'm a senior mortgage loan officer with over 25 years experience. I have won multiple local and national awards, and I was a 2014 State of Minnesota Loan Officer of the Year. So, what we usually talk about first is when you start thinking about buying a house is look at the big picture and kind of start with creating a budget. What can you afford? Now, one of the things that we always tell you is we are going to determine how much you can get a loan for, not how much you realistically want to afford. Well, what does that mean? Well, that basically means, let's say for sake of argument, I look at over your overall picture and I say you can afford a $400,000 house. But based on the payments and everything you got going on, you're not comfortable with more than a $300,000 house payment. So that's kind of for you to decide. So just understand there's a difference between what we might say your maximum is will let you get a loan for and how much you are comfortable affording. When we talk to you after your application and everything, we'll kind of go over that a little bit with you, and we'll ask about your payment comfort level and that kind of stuff. Part of that overall budget is, you got to keep other things in mind. So, if you're looking to buy a townhouse or a condo, not only do you have the mortgage and taxes and insurance, you also have homeowners association dues. Of course, you always have utilities, gas, electric, water, that kind of stuff. You should always think about keeping some reserves for home maintenance. Myself, this last year, I had a hot water heater that needed to be replaced. So, kind of got to think of that. But then here's the bigger ones, right? Is when we do home loan approvals, we don't look at daycare costs. We don't look at your phone bill. We don't look at how much you like to go out to eat. So that's kind of one of those big things that you have to factor in between maximum loan amount we will allow and your payment comfort level. So mortgages, how do they work? Well, the term mortgage is kind of a general term that covers really two different actual documents. The first is a promissory note. So the promissory note is pretty simple. I promise to pay the loan back. Okay. You will also sign a second document. That document is actually called the mortgage. The mortgage is a document that basically allows the lender to foreclose and recover the property if you fail to pay. So ultimately, the big thing here to always remember is this right here: no pay, no stay. So of course, when you're getting a home loan and you're buying a house, there's quite a few people that are involved in the mortgage and real estate process. Of course, there's your mortgage consultant. Lots of people say loan officer, same difference. Of course, your real estate agent who will show you houses and help you negotiate. Then on the back side of mortgages, we have processors and underwriters who will work on your loan. We have an appraiser who will determine the value of your property. You have the option of a home inspector who will inspect the house. Appraiser might be there 20 minutes while the home inspector might be there 2 or 3 hours. You do have closing and title companies. Title companies make sure that the clean title on the house, that the seller is the legal seller of the house, that there's no liens or encumbrances on the property, so that when you sign on the dotted line, you have clear title. And then finally is the mortgage servicer. That's basically who you make payments to down the line once your loan is all done. That can be the same company you do your loan with, or that can be somebody different. So, getting a home loan, there are basically 3 different types of lenders. This says banks, but this also basically includes credit unions. These typically have unlicensed loan officers and are only able to offer the loan programs that the bank hands. Most bank and credit union loan officers are very limited education. They're really glorified application takers. So they take your application and pass it along, and other people work on your loan. mortgage broker, significantly better. These are now licensed loan officers. But they do have a limited control because they are not the actual lender. Underwriting is done by the company that they actually send the loan to. But they do also have access to many lenders, so definitely better than a bank with licensed loan officers and access to more lenders. Now, correspondent lender, that's what we here at Cambria Mortgage are. You've probably never heard of the term correspondent lender, but basically anybody who's not a bank, so our name, Cambria Mortgage, it doesn't say bank. So when you see a name like that, they're either going to be a broker or a correspondent lender. So it's kind of hard to differentiate. I usually tell people to ask, are you a broker or are you a correspondent lender? So as a correspondent, we're the actual lender. We make the underwriting decision. We have underwriters. We handle the entire loan from A to Z. Again, where brokers are sending it, taking your application, but sending the loan off to the actual lender. We also have access to lots of other lenders if that needs to happen for various reasons. And so the way I kind of like to express it is we're kind of like a super broker. So we have all the benefits of a broker and a whole heck of a lot more. All right, beginning the mortgage process. So there's really kind of two things. I mean, most people call and they start out with, hey, I'm thinking about buying a house, and they have some basic general questions. And kind of that basic general question aspect is kind of, let's think of pre-qualification. I've talked to you, but I haven't verified anything. Where a pre-approval is, we've talked to you, we've taken an application, and we've verified everything. So it's pretty straightforward, right? General pre-qualification, talk to you, ask you how much you make, for example. How much do you make? I make $50,000 a year. Okay. So we get that basic information. We typically do a soft pull credit report. So a soft pull doesn't affect anything. It doesn't show up as an inquiry. It doesn't affect your credit scores or anything. And we're able to give you typically some pretty good ballpark answers, right? So again, information, none of it verified. Well, eventually, if you're going to buy a house, you definitely need to move into the pre-approval letter, and it's definitely definitely the best option. So now again, we're going to take that full application. We're going to pull an actual credit report, which generally isn't any different, but now this one will different than a soft pull. But this one now shows up as an inquiry on your credit report. We're going to fully verify your documents, right? I need to see W-2s, pay stubs, bank statements, and then we're going to make an actual decision, right? We're going to say, yes, you can get a loan up to X. All right, well, when you're doing that loan application and we need documents, we're going to need a couple things. This is a little list of the most common things that we're going to need. Typically, your last 30 days of pay stubs, your 2 most recent bank statements, your most recent W-2s. This does say tax returns, but that's typically only for self-employed. We may need some retirement and investment statements, your 401k, of course, and we definitely need your social security number. So how do we get started? Well, we complete an application. By completing the application, there's no cost and there's no obligations, right? We're going to look at everything. If it works, great, you buy a house. If it doesn't work, you don't like the answers, there's no cost, there's no obligation, you didn't hurt anything, you didn't damage anything. So there are multiple ways to apply for a mortgage loan. You can do an old-fashioned office visit here at Cambria Mortgage. We have 4 metro locations that I'd be more than happy to meet you at. Lots of people, we just do applications over the phone. That's very common. These days we also do some Zoom applications. People like to, kind of like we're doing now, where we're doing Zoom, where we can see each other. It's kind of like having a sit-down application, but we're doing it online. So that's become very popular since COVID. Our very popular mobile app, the next screen, I'll show you a little bit on our mobile app, but that's super popular. Install the app on your phone, do everything on your phone or iPad. And then, of course, an online application, just go to the website and you can complete an application. This works real good, and I highly recommend it if you have access to a desktop computer, because it's a lot easier to do the online application on a desktop than it is to do on your phone. So contact information. So get your pen out, write these things down, right? So of course my phone number, 651-552-3681. That's how you get a hold of me directly. If you're looking to do an online application, that's the joemetzler.com/apply. That'll take you straight to the application. If you're looking to install our mobile app, and again, I'll show you a cool video here on the next screen, just go to joemetzler.com/mobile app and you are able to download it. We do have 4 metro locations. My physical office is in West St. Paul, but if you're closer to one of these other offices and you want to have a sit-down application, I am more than happy to meet you at one of those offices. We do lend in multiple states: Minnesota, Wisconsin, Iowa, North Dakota, South Dakota, Texas, Colorado, and Florida. Florida, we do a fair amount for people we may have done here, but now they're looking to buy a vacation home or something in Florida. And of course, I've had plenty of clients here that I've done loans for who've moved to Florida, so we can take care of you with a Florida loan application also. All right, the Cambria Mortgage app. Here's a cool little video on the Cambria Mortgage app. I'll take a quick little watch here. How cool is that? That app is super popular, and we strongly recommend that you install it on your phone. All right, here we go. The loan process from A to Z, the basic process of getting a home mortgage loan on your new house. So, breakdown, the first thing is, again, is meet with your Cambria Mortgage loan officer. We need to have you complete an application. Again, we start with a soft pull, which doesn't affect anything. We're going to get some basic information, discuss your financing options, see what programs work for you. If you like all that, then of course we're going to move into a full pre-approval, which of course you need to submit your documents for review, W-2s, pay stubs, bank statements. We'll get all that sent over to underwriting for an initial approval, which gets you the pre-approval letter. Pre-approval letter is super important, right? Real estate agents love to sell you houses, want to sell you houses, but at the same time, they're not tour bus operators, right? They're not going to drive you around looking at houses if they don't know that you can get a loan. Same with sellers. When the time comes, you found that house and you want to make an offer, sellers need to know that you can get a loan. And that's basically what that pre-approval letter says, is you've gone through the process and a lender has said, yes, we will give you a loan. Then as you're out looking at houses within your price range, you'll eventually find one that you like. You'll make an offer on that. You'll sign the purchase agreement and, of course, notify me that you've made a successful offer. Once you've made that successful offer, I have to do a couple other things. First, we're going to send you some disclosures, right? So now we're going to send you paperwork to sign with all the additional information of the exact house, the exact price, the exact address, all that kind of stuff. You're probably going to schedule an inspection. Those are kind of important. As a lender, we're going to schedule the appraisal, which checks value. You need to get homeowners insurance. We can help you with that. As all that stuff comes in, we're going to finalize your loan approval. Eventually, as we go through that process, it is common for us to ask for updated documents. Maybe you were pre-approved 2 months ago, so we're going to ask for maybe updated pay stubs. But eventually, you are going to get final approval, what we commonly refer to as clear to close. Yay, everything's done. Your loan is clear to close, right? So we schedule a closing date and time. We will send you final disclosures on exactly how much money you need on the day of closing so that you can wire your down payment money and closing costs to the title company, or most people just get a cashier's check. You're going to go to closing, you're going to sign the paperwork, and of course, yay, again, you're going to get the keys and move into your house. All right, your mortgage payment. What does your mortgage and payment include? Well, of course, it pays the principal, paying back the loan, right? Got to pay back the loan. There is interest. It's not free to borrow money, right? You have to pay to borrow money, which is, of course, ultimately known as your interest rate into that. You also have to pay property taxes. You also have homeowners insurance, fire, theft. If a tornado comes by and blows your roof off, right, you need to have insurance to replace the roof. If you are putting a small down payment, generally less than 20%, you are going to need mortgage insurance. Mortgage insurance is what I call the necessary evil. It's evil because you got to pay it, and everybody hates that, because it adds to your costs. But because of risk, it is definitely necessary if you're going to put less than 20% down. You'll hear people talk about some creative ways to avoid mortgage insurance, but ultimately at the end of the day, you're not getting around it. You may switch it around, but you're not avoiding it if you put less than 20% down. All right, here we go. We're going to take a peek at popular loan options, right? Home financing isn't one size fits all, right? Not everybody qualifies for everything. One loan might be better than a different loan for you. We get people all the time that come in and say, hi, Joe, I'd like to apply for a loan. My agent said I should apply for an FHA loan, or I should apply for a conventional loan. And that's great, and we'll look at those, but we want to let you know that we don't just look at those. We look at everything, right? So regardless of what you asked for, we're going to look at all the various programs and see which one is going to be the best one for you. Maybe it's the one you called about. Maybe it's not. But just understand that we're going to look at all those different loan options and see which one best fits you and your situation. So the most common loan is a standard conventional loan. This is kind of your plain vanilla loan. This is typically your standard 30-year fix. It can be different terms, right? You can do different years. The screen says 25, 20, 15, and 10. You can actually do anything in between if you wanted. You could do a 22-year loan if you wanted, although most people don't realize that and hardly ever ask for that. Of course, it can be an adjustable loan. Lots of people have fear of adjustable loans. I think adjustable loan is the right loan for many people. Right loan for the right people in the right circumstance, but the wrong loan for lots of people. Current mortgage guidelines as the date of this recording, which is March 2023. You can get these loans up to $726,200. If you're getting a loan higher than that amount, that is a jumbo loan. Jumbo loans still are kind of your standard 30-year fixed or whatever, or adjustable, same thing. The difference is once you go above $726,200, guidelines change. For example, that 3% down payment that you could probably get away with on a standard loan, on a jumbo loan, realistically, 20% is your starting point. Then you can always ask seller to pay some of your closing costs. Typically, this amount is up to 3% of the loan amount. So that really helps if you can roll that in, get the seller to pay, because that really helps reduce your out-of-pocket expense. FHA loans. FHA loans have been around since, I believe, 1934. They're great loans. One of the best things about them is they only have a minimum 3.5% down payment. And weaker credit and more recent credit issues are allowed. Like, for sake of argument, if you've had a home in the past and you had a foreclosure, a conventional loan is a massive 7-year waiting period before a conventional will give you another loan, where FHA is only a 3-year waiting period. It does have a little bit lower interest rates. The sellers can pay closing costs. This time they can pay more. Gifts are allowed. Co-signers are allowed. You do have to have mortgage insurance regardless of your down payment size. And one big thing to understand, if you are looking at a condo, Condos have some additional requirements, and sometimes because of how the condo association is set up, we may have trouble giving you an FHA loan on a condo. VA loans. VA loans are great loans for our military, active or veterans. Of course, the biggest benefit of a VA loan is no down payment and no mortgage insurance. So, if you put a small down payment on any of the other loans, you have mortgage insurance, right? No down payment and no mortgage insurance. That is awesome. Plus, rates are lower. They're not hugely lower, but they're a little bit lower. So if you have VA benefits, this is a well-earned benefit, right? This is awesome. Condos, just like FHA loans, are a little bit tougher. FHA loans, I didn't format the screen here, right? But VA loans do have an upfront funding fee. But if you have a 10% or higher disability, then the funding fee is waived. So that be sure to, if your VA, we'll be sure to look at that for you. USDA loans. USDA loans are for properties in rural areas. So you can't use a USDA loan in Minneapolis, right? But you can in the rural parts of the state. Of course, the best benefit of a USDA loan is also a zero down payment loan. But these FHA loans do come with tougher restrictions. They have lower debt to income ratios. There's household income limits. Sellers can't pay your closing costs. Rates are a little bit lower. Again, not huge, but a little bit lower than conventional loans. There is mortgage insurance, right? And this one, even though it's USDA, it's always kind of funny, but farms aren't allowed, right? So they really want more of your regular house in a small town, not your 20-acre farm with a bunch of cows. First-time home buyer and down payment assistance. Boy, are these popular, and we get the calls on these all day, every day. Super, super, super popular. So there's kind of two elements to this as first-time home buyer. So first-time home buyer, if you meet the requirements, generally you get a just slightly better interest rate and slightly lower mortgage insurance with a small down payment. You have to take a class. You have to take a home buyer education class in order to get that. So if you fit the guidelines, just the basic first-time home buyer, you're going to save a little. It's worth it. But the bigger one that people typically ask for is the down payment assistance, right? So how that basically works is, let's say your normal loan, your normal down payment is 5% or 3%. Let's say 3%, okay? So your normal down payment is 3%. But what we're going to do is there's the screen, you only have to put in a minimum of $1,000 of your own money, right? That's your minimum. You'll never be less than that. You have to put in a minimum. But let's say the rest of what you need would be $10,000, right? So what we'll do is you have to put in a minimum of $1,000, and we will give you a $10,000 assistance loan to cover the rest. It's awesome. Now, these loans are not free, right? These loans are not free. They are loans. So the loan comes in two flavors, and they are based on your household income. So the first one is what we call a deferred loan. So let's say I give you that $10,000 assistance loan, but what's cool is there's no payments, there's no anything, there's no interest. If you borrow $10,000, you pay back $10,000, but you don't have to pay it back until you sell or no longer occupy the property as a primary residence. So let's say you turn it into a rental, okay? Income limits do apply. The second one, and especially if you have a higher income, you can get that assistance loan, but now you have payments, okay? So you would have your regular first mortgage payment due each month, and you'd have the second mortgage, the assistance loan payment each month. So you'd have the two. So again, they're not free, they're not gifts, they're not grants, they're assistance loans that need to be paid back, and based on income, one of the two. There are tougher underwriting guideline requirements when you do zero down. There is mortgage insurance just like any other loan. Sellers can pay your closing costs, and that's typically something we almost always do on these. Again, household income limits. We have property location limits on some of these. We have purchase price limits. Credit score limits, for example, most of these programs require at least a 640 or higher credit score. So, it's best to complete a full application, and with that full application, I can zero in like a laser beam if you fit one of these first-time home buyer and down payment assistance programs. Lastly, in my little screens here is alternative loans. Hey, not everybody qualifies for the regular everyday loan, but just understand that there are a wide variety of alternative loan options. Some of the most popular ones here are loans for self-employed. Self-employed, their tax returns are able to write off a lot of income. So on their tax return, it looks like they may not make much money. So there's alternative programs. The most popular one is we use bank statements for proof of income versus tax returns. There's other ones, right? If you got a lot of money in the bank, we can use assets only, right? How much you have in the bank if you got a ton of money in the bank. This one's very popular. If you're buying an investment property, there's no proof of income. We qualify you based on positive rent, right? So if the rent's $2,000 a month and your mortgage payment's $1,800 a month, congratulations, right? Rent is higher than the down payment. 1099 is also, there's a lot of people who are 1099. That technically means you're self-employed, so that brings us back to a lot of the self-employed problems. But we have some cool loans where we just need 1099s as proof of income. All right, interest rates. Interest rates are one of the biggest questions. Oh, again, I forgot to format the screen right here for a Zoom meeting. But interest rates. Interest rates are one of the most important things that people ask about. What's interest rate? Well, there's a lot of things that control interest rates, right? Interest rates are based on mortgage-backed securities on the bond market. Mortgage lenders don't just make up interest rates. Based on the mortgage-backed securities on the bond market, then we add a margin, just like any other person. A Target buys shoes for X and adds a margin and sells them to you. Lenders do the exact same thing. Okay. So lots of things go into that control mortgage rates. Other things that control mortgage interest rates for you personally are credit scores. If you have higher rates, you get better scores. Or excuse me, if you have higher scores, you get better rates. Right? If you have lower scores, you're higher risk. Right? Your rate's going to go up. Down payment and loan amounts. So again, sorry I didn't properly format the screen here, but basically down payment sizes can affect interest rate. Different loans that you're doing, for example, a second home or an investment property, interest rates are higher on those because of risk. So the big one people think about is the Federal Reserve, right? The important thing to understand is the Federal Reserve does not set actual mortgage interest rates, right? But what the Fed does affect interest rates in the long run. But basically how I try to explain it is if there's 10 things that go into an interest rate, what the Fed does is just 1/10, right? There's 9/10 of other things that affect rates, right? Things like big worldwide events, think 9/11 and COVID, right? COVID, wow, drove interest rates to incredibly low numbers that we've literally never seen before. But I want to leave you with this on this screen. Interest rate does not always trump everything. Well, what does that mean? Okay? There's a lot of bait and switch that still goes on out there, right? All lenders have the same cost, right? I can't magically do loans cheaper than somebody else, right? We all have the same appraisal, credit report, state tax, county recording fees, right? We have all that stuff, right? There's a certain margin that we have to make in order to stay in business, right? So just be very wary of the guy quoting the lowest, right? Because if they can't get your loan closed, that great interest rate didn't make any difference, right? You should feel comfortable about your lender. And one other thing along that too is one of the big things to understand is the company you use doesn't matter that much. Oh, I forgot to shut off my, forgot to put my phone on Do Not Disturb. Oh, let me quiet that there. All right. What was I saying now? Oh, so the lender that you use is not anywhere near as important as the loan officer you choose. The loan officer is the big thing to choose. You need someone with a lot of experience, typically at a correspondent lender with lots of options, somebody who's seen everything. I've been doing mortgage loans for more than 25 years, and believe me, I've seen just about everything. It's pretty rare that a situation is something I haven't seen before. All right, so while you're in the mortgage process, here's a couple of big do not do's, right? Take a look at the screen. Do not do's, right? Um, don't go moving money around. Don't make large deposits. If you got a bunch of money, in a brown paper bag under your mattress, don't go magically put that in the bank. Don't make new large purchases. A common mistake is people will go out and buy new furniture once they find the house, and that can be a problem or it can not be a problem. You really need to not do anything without talking to your loan officer. Well, what do I mean by that? Well, let's say you qualified and your debt ratio is really high and you just barely made it in. Okay, well, you go out and buy new furniture. Well, as soon as you bought that new furniture, I have to add that new furniture payment into your debt to income ratio. Maybe that pushed you over the limit and now you're literally denied. Holy moly, that's terrible. Now, the next guy, he may have a very low debt to income ratio, and if he goes out and buys furniture, I add the payment to his debt ratio, and it doesn't really matter. So the big thing to learn is do not do anything on this screen without contacting your loan officer first. All right, so we're pretty much through the main element, and so I want to just do kind of a final review. How does the mortgage process work? Well, the first thing is reach out to us. Reach out to your Cambridge Mortgage loan officer. As you reach out, whether you do it online, over the phone, on the app, whatever, we need to get an application. With that application, we're going to review your overall situation, right? Submit your documents, W-2s, pay stubs, the bank statements. All that stuff goes into initial underwriting review. With that review, we're going to determine house price you can afford, what monthly payments might look like, your cash to close, and all that looks good, we're going to give you that pre-approval letter. With that pre-approval letter, now you can go out and meet with your real estate agent, because now you're going to be able to set realistic house requirements, right? I thought I could afford a $400,000 house, but I guess I can only afford a $300,000, right? So I was looking on the internet at $400s, but I need to tell my agent I can only look at $300s, right? So this allows you to set realistic house requirements. Well, then, of course, the agent will help you shop, right? You're going to get out there, look at houses. Typically, they set you on some automatic stuff where as houses pop up, you automatically get emails every day. Then you're going to be out there shopping, looking at different houses. Of course, you're going to finally find one that you love. So you're going to make an offer. Hopefully your offer is accepted. Once your offer is accepted, then we move everything over into final underwriting. Again, final underwriting, now we need an appraisal on the exact house. May need some updated documents. As all that goes through all that process, you get insurance and all that kind of stuff. Then we ultimately get clear to close, right? Everything is done. Everything is approved. We're just waiting for the closing day. Of course, on the closing day, you're going to sign all the paperwork and get the keys to your new house. Congratulations, you are now a homeowner. So that pretty much concludes our seminar here. So we're going to move into a Q&A for the recording of this seminar. I'm going to stop that part here, but for the rest of you here on Zoom, we're going to stay here for a little bit. So feel free to start sending me any questions, and we'll try to get those questions answered. Thanks for watching. Have a great day. I look forward to sitting with you at the closing table while you're handed the keys to your new house.